The screens glowed red across Washington as the August deficit figures came in. $345 billion gone in a single month, according to data released by the U.S. Treasury on September 11, 2025. Even with tariff revenues surging to record highs, the budget hole widened. Year to date, the United States had already amassed nearly $2 trillion in red ink, the highest level outside the pandemic bailouts of 2020 and 2021. The number did not whisper of strain. It screamed of a system under siege. Officials pointed to the customs duties as proof of policy success. Net receipts from tariffs hit $31 billion in August, more than quadruple the level from a year earlier. Treasury staff described it as one of the largest monthly hauls on record. Yet the contradiction was unavoidable. Spending outpaced these inflows almost immediately. Social Security payments alone rose by $9 billion year over year, while net interest costs jumped by $13 billion in the same month. Interest payments are now one of the fastest growing obligations of the federal government, consuming over $1 trillion across the first 11 months of the fiscal year, Reuters reported. This is why the deficit matters less as an accounting exercise and more as a pressure gauge. Tariffs, hailed as weapons of economic statecraft, are generating revenues at a rate unseen before. But those dollars are arriving only to be devoured by the weight of entitlements and debt service. In August, receipts totaled $344 billion, but the government still outspent itself by almost the same amount. To imagine working 4 months of the year solely to cover minimum credit card payments is not far from how the federal balance sheet looks. The line between sustainability and imbalance is narrowing with every auction of Treasury debt. Across the Pacific, another ledger is shifting in ways that rattle the assumptions underpinning America's finances. At the end of August 2025, the People's Bank of China reported that its gold holdings had climbed to 74 million fine troy ounces, adding 60,000 ounces in just 1 month. The value of those reserves reached roughly $253 billion, representing 7.64% of China's total foreign exchange stockpile, according to the South China Morning Post. It was the 10th consecutive month Beijing disclosed an increase, a streak that suggests deliberate policy rather than coincidence. Gold's appeal is simple. It carries no counterparty risk. The United States cannot freeze bullion in Beijing's vaults the way it froze $300 billion in Russian reserves. This risk of confiscation has been a recurring theme among Chinese economists. Analysts at the Bank of China have warned publicly that holding vast sums in treasuries is a vulnerability, not a strength. The lesson from Moscow's experience in 2022 remains etched in policymaker memory. If reserves can vanish with the stroke of a sanction, then diversifying into assets immune from seizure is not paranoia, it is prudence. The numbers suggest Beijing is executing that shift with discipline. Since the start of 2025, official purchases amount to nearly 23 metric tons. Independent trackers like the World Gold Council believe actual accumulation may be higher once military, commercial, and offshore channels are considered. This divergence between reported and unreported stockpiles forces markets to guess whether China already holds closer to 2,500 or even 3,000 metric tons. Either figure would make it the world's second largest official holder after the United States, and if the growth rate continues, parity is not unthinkable. Meanwhile, the cost of America's borrowing continues to rise. Net interest payments through August 2025 totaled over $1.124 trillion, $76 billion more than the same period last year. Those costs rise automatically when yields on treasuries stay high. Every 1/10 of a percentage point in rates translates into billions in additional obligations. Oxford Economics projects the full-year deficit will close around $1.78 trillion, slightly less than the year-to-date pace, but still historically large. The Committee for a Responsible Federal Budget warns that by 2035, annual deficits could exceed $2.6 trillion, representing nearly 6% of GDP. This dual movement, China insulating itself while America leans harder on tariffs and borrowing, feeds into a broader global realignment. Central banks from Ankara to Riyadh have increased their gold allocations. A World Gold Council survey this summer found that 95% of reserve managers expected to add more bullion in the next 12 months, with 43% planning significant increases. The signal is not ambiguous. Trust in dollar assets remains, but hedging behavior is expanding. Each ounce of gold acquired by an emerging market central bank represents a vote against unbounded reliance on U.S. paper. Markets have responded in kind. Gold futures on COMEX were up nearly 38% year-to-date by early September. Morgan Stanley analysts forecast another potential 10% rise by the end of 2026, driven by central bank demand. If those predictions materialize, then every additional purchase by Beijing both protects its reserves and pushes the global price higher, amplifying the effect. For foreign investors holding $8 trillion of U.S. assets in Europe alone, the consequences are severe. More than half of those holdings are unhedged. A declining dollar wipes out returns even if equity or bond prices rise. That erosion of confidence can trigger feedback loops. If a sufficient share of investors hedge simultaneously, currency markets adjust violently. 2 or 3% daily moves in the dollar, long considered extraordinary, could become regular. July's deficit report already illustrated the paradox. Tariff revenues tripled year over year, but the deficit still rose 19% to $291 billion. That mismatch underlines why foreign creditors might hesitate. If higher tariffs cannot restrain borrowing, then what policy lever remains credible? One answer has been floated by administration officials: lower rates to reduce servicing costs. Stephen Moran, nominated for a key Federal Reserve position, has spoken favorably about a weaker dollar as a competitive tool. If interest rates fall sharply, debt dynamics ease in the short run. But the signal to markets would be unmistakable. The United States is willing to debase its currency to preserve fiscal room. For nations already seeking alternatives, that message accelerates diversification. Each cut could translate into more selling of treasuries abroad, not less. The European Union faces its own dilemma. Holding trillions in United States bonds, European funds are exposed to currency swings they cannot fully control. If the dollar slides, their portfolios hemorrhage. Hedging is costly and not universal. Japanese investors confront the same problem. Their pension funds have accumulated vast holdings of treasuries, but yen weakness magnifies dollar volatility. Every central bank calculating its reserve composition must weigh these risks against the liquidity and depth of United States markets. Liquidity has value, but it cannot offset confiscation risk or prolonged currency depreciation. This is why China's regulatory changes in September drew close scrutiny. Bloomberg reported that Beijing is considering easing import and export restrictions on gold, widening the number of ports and streamlining permits. Such measures would allow larger volumes to enter the country with fewer bottlenecks. In practice, it equips the state with the ability to accelerate accumulation if conditions demand. A sudden geopolitical shock or sanctions scare could see tonnage rise sharply without the delays that currently constrain logistics. For policymakers in Washington, that possibility looms as a strategic vulnerability. The IMF has documented this reserve diversification trend in its quarterly currency composition of official foreign exchange reserves database. While the dollar still accounts for around 58% of global reserves, down from over 70% at the turn of the century, the renminbi's share has risen steadily to above 7%. Gold's share, not included in that breakdown, has climbed globally as well. If official allocations continue shifting even gradually, the cumulative effect over a decade is substantial. A 5-point drop in dollar share translates into hundreds of billions leaving U.S. markets. Inside the United States, the burden is visible in auction data. Primary dealers are absorbing larger tranches of treasury issuance when foreign demand softens. Yields creep higher as supply outpaces absorption capacity. The higher those yields climb, the more attractive the dollar should be. But if foreign investors believe depreciation will outpace yield gains, the logic breaks. They sell even as rates rise. It is this inversion, higher yields coinciding with weaker demand, that poses the most significant challenge to Washington's financial strategy. Consider the numbers from the Bipartisan Policy Center. Federal debt surpassed $37 trillion in August 2025. The interest component alone now threatens to consume 40% of revenue within a decade if trends persist. Tariff revenues, while dramatic in growth, represent only a fraction of that need. $30 billion in August was substantial, but interest costs in that month alone were nearly triple. The math does not reconcile easily. To imagine tariffs bridging the gap indefinitely strains credibility. For Beijing, the strategy appears clearer. Reduce exposure to confiscatable assets, increase holdings in physical stores of value, and encourage BRICS partners to trade in local currencies. Already, Russia and India are settling portions of oil and commodity deals outside the dollar system. Brazil has experimented with yuan-denominated trade financing. South Africa has raised discussions about establishing regional settlement frameworks. Each step is incremental, but the pattern aligns with a long-term effort to minimize dollar dependence. The implications extend beyond finance. If global trade flows increasingly bypass dollar settlement, the United States loses not only seigniorage, but also leverage. Sanctions lose potency if counterparties have alternate clearing mechanisms. Military spending becomes harder to sustain when deficits rise unchecked. Diplomatic influence, long buttressed by economic dominance, weakens as reserve managers diversify. The numbers in August, 345 billion lost, 60,000 ounces gained, are not isolated data points. They are signals of two trajectories diverging. Where does that leave the international system? One hypothesis is that the dollar adapts, supported by depth and inertia. Another is that the shift accelerates, forcing a multipolar reserve structure within the next decade. Evidence exists for both. The dollar still dominates global trade invoices and debt issuance. Yet gold's resurgence, China's consistent accumulation, and America's swelling deficits all point toward erosion of unquestioned supremacy. Each additional billion in U.S. interest costs, each ton of gold shipped into Shanghai, shifts the probability weight. Midnight in Washington again. Treasury staff prepare the schedule for the next auction. Hundreds of billions more in short and long-term bills. In Beijing, shipments of bullion clear customs under new streamlined procedures. In Frankfurt and Tokyo, portfolio managers recalculate hedging strategies against potential 2% swings in the dollar in a single week. And in Riyadh, central bank officials mark allocations to gold that once seemed excessive but now feel defensive. The scene is global, but the axis is narrow. America spends, China accumulates. One builds obligations, the other stores insulation. Between them stretches a financial system accustomed to the stability of a single reserve anchor. The question is whether that anchor still holds. When deficits expand faster than revenues and reserves shift from paper to metal, the chain connecting them all begins to strain. How much more weight can it carry before it snaps? We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.